What's up, guys? How are you doing today? It's your guy TradeRicch here. So in the last video we talked about the types of liquidity you need to know as a trader, but in this particular video I'm going to elaborate on the extended liquidity. I'm going to show you how I use it to catch pro trends and counter trend. So don't forget to click on the like, subscribe and turn on the notification button so you can get notified when I post another content on trading. So let's go. I told you guys that we have different types of liquidity. We have the Asian range, we have the extended liquidity, we have the buy side liquidity, and we have the sell side liquidity. So in this particular video, I'm going to show you how I actually bank on pro trend and counter trend with the extended liquidity. So let's say, for instance, we are in an uptrending market scenario, right? We're in an uptrending market scenario, right? Market structure tells us, the concept of market structure tells us that we have series of higher highs and higher lows in an uptrending market scenario, and we have series of lower highs and lower lows in a downtrending market scenario. So in this case, whenever I want to bank on a retracement, instead of waiting for price to give me a pullback, then waiting on the actual move before I join the trend, I'm actually going to bank on this retracement from here, right? I'm actually going to bank on this retracement from here. And the question is, how do I manage to get into this kind of move? Well, it's quite simple. I just apply the extended liquidity concept on the chart, and this is exactly what I do. So what you have to put into consideration is that every high and low you see in the market are supply and demand zone. This is an area of supply, right? This is an area of supply. Why this is an area of demand zone, right? So you have to see all of these high and low points as area of liquidity, because if there was no liquidity here, price wouldn't have pushed to the upside to take out these sellers here. So there's liquidity everywhere in the market. We have liquidity at this top, we have liquidity at this bottom, we have liquidity at this top, we have liquidity at this bottom. So every high and low points are areas of supply and demand. For the fact that I know that every high and low are areas of supply and demand, then it is very, very easy for me to bank on that kind of trades, right? And so this is what I do. Having know that this is our supply zone, right? This is our supply zone, but this supply zone is failing to hold price, so it is a liquidity area. So all I do is just draw my liquidity line, right? Then wait for price to come back inside of that zone, right? Then I wait for price to come back inside this zone. So once price comes back inside this zone, right, then it's telling me that it is ready to push to the downside. Then all I do is just allow price to move into this zone, then put my entry here, my stop loss above this zone, then I'll catch the counter trend. Even though most times the counter trend is doesn't give good risk to reward, but sometimes they give good risk to reward if you move to the lower time frame to refine your entry. So this is exactly what I do. So I already know that price is going to give me after a new higher high and a new higher low, I'm waiting for price to create another higher high, then move to the downside to give me a new higher low formation before moving to the downside, right? So this is what I do. I wait for price to come back inside of this zone, right? I want price to come back inside of this zone, then start pushing to the downside. So this is where I take my entry. This is where I place my entry, then my stop loss just above this zone, then my target around this demand zone, because I know that price is going to reverse from here. So this is how I can manage to bank on pro trend and counter trend. So the question is, why do I have to sell from here? What's the psychology behind it? The psychology behind it is that there are supply and demands at every point in the market. Where price are reversing from are support and resistance, right? Support and resistance are zone where major reversals occur. Likewise, supply and demand. So if you trace this to the left hand side, you observe that price is trying to react from a zone of supply zone. Right? Price is trying to react from a supply zone, right? On the downtrending market scenario as well, I catch the pullbacks, right? I catch the pullbacks. So let's say, for instance, I want to catch this pullback. All I do is wait for this low to be liquidated, right? Which is an extended low, because everyone sees this area as a demand zone, because that is exactly what it is. This is a demand zone, right? So you have to see every high and low point of this structure as supply and demand areas, and there are areas of liquidities in the market. So when it fails to hold price, that means this other block is not valid, right? Then I said something in the previous video that once you have our order block invalidated like this and it comes back inside our order block, then it's a valid trade setup for us, and this is exactly the psychology behind it. So once price moves inside of this structure back, right? Let's say price moves inside of this structure back, then I'll be ready to take this trade. Then my my entry will be here. Then my stop loss just around this low or this low. Then my target around this area, right? So sometimes it gives 1 to 3 risks to reward, 1 to 4 risks to reward, 1 to 5 risks to reward, depending on how big the impulsive move is. So if you trace this reaction to the left hand side, you observe that it is reacting from a demand zone, right? But it's not necessary that you draw your zones out, but just have this idea that price has liquidated this low and price is moving back inside this low. That means this retracement is about to happen. Now let's go to the chart. All right, so just like we have it here, you can see we have a push to the downside, right? We have a push to the downside, a retracement, another push to the downside, a retracement, another push to the downside. Then we have price moving to the upside, right? So how can you bank on this kind of trade? Well, it's quite simple. So just use you can use your horizontal real line, then you can just use your trend line tool to identify these areas. So because I know that price should come back to fill this imbalance in price action and respect this order block, then it has given me that good confidence to buy from here once I spot something like this. So you can see what happened there. You can see what happened there. We have a break of this structure, price put to the upside. After coming back to, this is a demand zone, remember this is a demand zone. Then after price liquidated this demand zone, price moved back inside of that demand zone, and what happened? Price made that retracement. But I cannot bank on this kind of trade because it's not giving me a reasonable risk to reward. So I'll let it slide, right? I'll let it slide. So this is another opportunity to bank on that kind of trade. This low was liquidated, whereas this is a demand zone, this is a rejection block, right? A lot of people are seeing a shift market structure here, then expecting price to react from here, then moving to the upside. And you can see what happened. Price liquidated this low. Price liquidated this low. Let me draw horizontal ray. You can see how price liquidated this low and then moved to the upside inside of this order block again. So this is a valid trade setup for me, right? This is a valid trade setup for me. Then I'll place my stop loss at this low. Then because I know that I want price to come back towards this order block, then my target will be here. But when putting my target here, that doesn't mean I won't take partial positions at this high, because same thing that happened here can also happen here. So I have to observe the market, right? I have to observe the market. I have to have a predetermined zone for where to take partial positions as soon as market moves in my direction, right? So let's take a look at another example. So you can see that price is giving us a series of lower highs and lower lows in this market condition, right? So you can see that at this point, price was giving us a series of lower highs, right, and lower lows. Lower highs, lower low, lower high, a big push to the downside to give us another lower low, lower high, lower low, lower high, lower low. The question is, how can you bank on this kind of movement? Let's forget about the pull trend here. I want to talk about how you can use it to catch retracement. So you observe that price is giving us after a break of market structure here. After a break of market structure here, then price liquidated this demand zone. This is a demand zone. It is area of support zone. Your support is your demand, right? So you can see what happened. Price liquidated this demand zone, then push to the upside again. You can bank on this kind of trade, right? You can bank on this kind of trade. Then stop loss here, right? Target around this supply zone, giving us a 1 to 3 risk to reward, right? That's one. So after this big push to the downside, right? After this big push to the downside, let's take for instance, you couldn't bank on this move to the upside, right? You couldn't bank on this move to the upside. But then we have a break of market structure here again, and see what happened. It is just about price action. You have to understand price action as well, not just about extended liquidity. You have to know what the candlesticks are saying, their languages, remember. So after this break of this structure, after this break of this structure, so you observe that price moved back into this demand zone, because this is a demand zone that failed to hold price, right? It was a demand zone that failed to hold price. Then what happened? Price came back towards this demand zone. Then what did I say about other blocks that did not hold price, but price pushed back inside of that other block? It is valid to take an entry from there, right? It is very, very valid. So after a lot of consolidation, and this is happening on the 4-hour chart, you can bank on it on the 1-hour chart as well, right? So after consolidating for a lot of time, the price pushed to the upside. So at this point, this is where I'll be entering the trade, right? Am I scaling into the lower time frame, or just take my entry of this 4-hour time frame, then place my stop loss just around this low, right? Then my target at this supply zone, giving us a 1 to 6.5 risk to reward, right? Because I understand that this is a supply zone, and we are still in the downtrending market scenario. We are still in that downtrending market environment. So it's just series of lower highs and lower lows. But then I don't want to wait for price to come back here before I start placing trades. I can see it will take a lot of time for price to move from this place to this place. So why not bank on it, since you have the idea of liquidity inducement concept? You understand extended liquidity. You understand what price is doing here. So at some point, I know that price is going to move from here, but I don't used to bank on this kind of trade. But then what's the importance of knowing that price is going to reverse from here and not even taking the trade while waiting for the original trend to get to my point of interest, right? So I don't have to wait for the original trend. I can bank on the retracement. It is just about knowledge, right? So I said to myself, it's enough of that waiting. I want to bank on this kind of trades, and it's working very, very fine. You can see it gave me a 1 to 6.5 risk to reward, right? Some of them will not give you 1 to 6 reward. Some will give you 1 to 8, 1 to 10, 1 to 3. It depends on that kind of market condition you are seeing on your chart, right? So I just take the one that is giving me a good risk to reward. I don't focus on the one that gives me 1 to 2 risks to reward, because I don't like to take 1 to 2 risks to reward. It just boils down to personality, right? So I just want to focus on the one that can give me 1 to 3 risks to reward and above, right? You can see what happened here as well. We have another break of this structure. What happened after this break of this structure? Remember, this is a demand zone, and this demand zone failed to hold price. After this demand zone failed to hold price, then price pulled back towards this demand zone. So this candlesticks you are seeing here, is this pin bar you are seeing here, is telling me something. So I don't have to wait for this one to close before I enter the market, because I've seen the formation of this candlestick. It's telling me that price is ready to push to the upside. Since it has met my confluence, I've seen that price is taking out this liquidity, and that it has put back inside this zone. So I'm ready to take this kind of trade at this point. Then my stop loss just below this low, right? Then my target at this supply zone. But this is why trade management is very important. This is another supply zone here, and this is a breaker zone. So I take partial positions as soon as the market makes money available to me. It might be different with you. You might want to trade, the way you manage your trade is different from the way I manage my own trade. So it boils down to preference. So I would have taken out majority of my positions at this point before price reversed on me. Same thing happened over and over again. Just go to your chart, backtest these things, and you see that it is valid, right? What happened here was as a result of liquidity, again, extended liquidity, because this is a rejection block, which is a demand zone, and this demand zone failed to hold price. Then after pulling back inside of this zone, then I'll place my entry here, my stop loss here, then target at this supply zone again, right? Giving me a 1 to 4 risk to reward. So it happens every time, over and over again. So you can see what happened here. I actually missed this trade opportunity, to be very, very honest with you guys. But as you can see, it is the same concept. Price was giving us series of higher highs and higher lows, right? Price was giving, after this break of market structure here, price gave us higher high, higher low, higher high, higher low, higher high. Then I was expecting another higher low formation. But on the higher time frame, which is the 4-hour chart, this whole move is a big impulsive move, right? Can you see? This whole move is a big impulsive move, and you can see that this is the last significant supply zone, and this is lower low. So this point you are seeing here is our new lower high. So I've seen everything on the higher time frame, then I went to the lower time frame to spot and enter the trade. So I still want price to keep pushing to the downside, right? This is the whole move. Lower high, right? Then the lower low, then another lower high, then another lower low. So I want to catch this move right from the top. I want to catch this move right from the top, and that is why I went to the 1 hour chart. And as you can see on the 1 hour chart, we have that extended liquidity. So price was reacting from this supply zone here. Price was acting as this supply zone. You might want to call it a resistance zone. It doesn't matter. Support and resistance is the same thing, right? Support and resistance is the same thing. So price rejected from this area, then put to the upside to liquidate this high as well, right? So after price has liquidated this high, I wanted to see price moving back towards this inside of this zone before I can take that entry. But this last candle gave me that confirmation that price is ready to push to the downside. So although I missed this trade, but this would have been my entry point, because this doji candlestick you are seeing here is telling you that the buyers and sellers are at equilibrium, and it's happening on my supply zone. So why not? So it's just a good confirmation for me to put on a trade at this point. So this will be my entry, and this will be my stop loss. Then target down below, right? Then I'll go to the 4 hour chart, right? 4 hour chart. Then my first target here, although I'll take partials as the market makes money available to me, so I like to use my Fibonacci retracement, the negative 27, for my final target. This should be my final target, right? This should be my final target. So the concept is extended liquidity. You can use it to catch pro trend, you can use it to catch counter trend. So on the 4 hour time, it is a pro trend. While when I went to the 1 hour chart, it was counter trend. So you can see how this thing works. So if you find this information useful, click on the like button, subscribe and turn on the notification button so you can get notified when I post another content about trading. Peace out.